Hello, I'm going to talk about chapter 8. So in this chapter, there are certain things we want to pay attention to. So first thing, we want to make sure that you understand how the stock prices depend on future dividends and the dividend growth. Okay, so you are investing in the stock markets, right? You are purchasing the common shares, right? So these stocks, not all of them, but some of them would issue dividend, right? So the promising future dividend and how the dividend growth is gonna affect the stock price. What are the characteristics of common and preferred stocks, right? So what are they? What are the common stocks, and what are the preferred stocks? What's the difference between them? So we're gonna talk about the characteristics of the different types of stocks, and understand the different ways corporate director are elected to share office. Understand how stock price are quoted and the basics of the stock market reporting. Okay, so common stock valuation. Okay, so that's the first section, and we're going to talk about common stock features, preferred stock features, stock market reporting, and then we finished with a summary and conclusion. Okay, so common stock valuations. So if you buy a share of stock, you can receive cash in two ways. Okay, so the first way is that the stock issuer, they are going to issue dividend to the investor. Okay, so you can receive some dividend back. This is one way. The second way is that when you sell the stocks on the stock exchange market, right, you may receive the money back, right? If you sell it at a higher price, you will have a capital gain, right? You will have a gain. So there will be two ways. Either when you hold the stock, right, you receive dividend. That's one type of the cash you can receive, or you sell it, right? You sell it. You received the cash proceedings. You have two ways to sell the shares. You can sell it to another investor, okay, or you can sell it back to the company. That's called redemption, right? Share redemption, right? When the share purchase back the stocks they issued, that's called share redemption. Okay, and in the previous chapters, we have learned that the price of bond is actually calculated, it's determined by the present value of all the expected future cash flows, right? So similar, the price of the stock is the present value of all these expected cash flows. Okay, so let's see one example. Okay, in this example, we are working on a problem with only one period. Okay, so suppose you are thinking of purchasing the stock of this company. You expected to pay a $2 dividend 1 year later. You believe that you can sell the stock for $14 at that time. Okay, so in this case, you can see that there are two different cash flows, right? So it's only 1 year, right? At the end of the year, you can expect two different types of cash flows. One is the $2 dividend. The other is the money you get from selling the stock, right? So how to do the calculation? In this situation, so after 1 year, you can receive $14 by selling it, and also you will receive the dividend for the 1 year you are holding the stock $2. So together, that's $16. That's the future money, right? To calculate present value, you have to discount it by discounting factor, right? So in this case, we assume the discount rate is 20%. So the price is the future cash flow 14 plus 2, $16 divided by 1.2. So the result is 13.33. Okay. You can also use calculator by assigning 16 to future value, 20 to the rate, and 1 to n, and you compute present value. Okay. Okay. So when you are expecting a 20% return on the investment, the maximum amount of money you are willing to pay is $13.33. Now let's use an example with 2 periods. Okay. So now if you decide to hold the stock for 2 years, so in addition to the $2 dividend in 1 year, you expect a dividend of $2.10 in 2 years, and a stock price of $14.70 at the end of the year 2. Okay, so now you have 2 years. So the first year is $2 dividend, so you discount it by $2 divided by 1.2. And the second year, you have a dividend, 2.1, plus stock price you will receive when you sell it, 14.7. So 2.1 plus 14.7, and this is at the second year. So you divide it by 1.2 to the power of 2. Okay. So in this case, the price is $13.33. How do you calculate this using a calculator? Okay, so there are different streams of the cash flows. So the first stream of cash flows, CF, representing cash flow. So CF 0, okay. So that is 0, okay. That is 0. And C, so that's for the present value, right? The 0 means now, right? So there's no cash flow now, but C01, so at the 1 year after, you have a cash flow of $2, right? And this is only for 1 year, so F01, that's equals 1 as well, okay? So here, this is your first streams of cash flow. This C means the amount, okay? The cash amount. This F representing the number of the sequence, okay? The number of the sequence. So in this case, you're gonna have the first cash flow that is $2. Okay, that's the amount, and it's only for 1 year, right? Only for the first year, right? And then for the second cash flow, the amount is the dividend 2.1 plus the price 14.87. Together, that's 16.8. Okay, and the this is also only for 1 year, right? Only for the second year. Okay, and now you press the NPV button, and you enter I, the discount rate, as 20, representing 20%, and then you compute net present value, and that returns you the same result, $13.33. Okay, so you just have to learn, how to do this. So you draw this timeline. Okay, So this is your CF0. Okay, here that's 0, 1, 2, right? And this is your CF1, and this is your CF2. Right, cash flow 2. Okay. So make sure you learn how to use your calculator to calculate the present value of multiple cash flows. Now let's take a look at the 3 periods. So if you decide to hold the stock for 3 years, okay, you expect to receive a dividend 2.205 at the end of year 3, and the stock price is 15.435. Okay, so in this case, for year 1, let's do the using the formula approach. This is the formula approach. So you use $2 for the year 1 divided by 1.2. And the second year, that's dividend is 2.1 divided by 1.2 to the power of 2. And the last year, you have a dividend 2.205 plus the price 15.435. Together, this is the cash flow at the 3rd year discounted by 1.2 to the power of 3. So when you do the calculation, you are going to pay $13.33. Okay. So in this case, you have CF0 equals 0, CO1 equals 2. That's the 1st year, and there's only one cash flow for the $2. And CO2, the 2nd year, $2.10. Again, there's only one for one cash flow for 2.1. And for number 3, that is the sum of these two, 17.64. So your CO3 is 17.64. Again, there's only one cash flow, 1764. And then you press NPV, assigning a discount rate 20%, compute NPV is returning 13.33. Okay, so that's how much the price you are willing to pay. So developing the models, okay. So you can keep pushing back the date when you want to sell the stocks. You can hold it not just 3 years, 4 years, 5 years, 6 years, even longer for the whole life, right? Nobody can force you to sell your stocks, right? Especially for those investors who go in with long-term investment, right? Instead, they are not doing frequent tradings for speculation, right? They are investing for the long term. So then they will hold the stocks for long term. They don't. So if you continue to push back the date when you sell the stocks, okay, so then the price of the stock is really just the present values of all expected future dividends, right? It's the present values of all the future expected dividend. So how should we estimate all the future dividend payment? Okay, we cannot know for sure, right? For the things that are not happening, right? We can just estimate. So how can we estimate all the future dividend payment? So let's take a look at some of the special situations. The first one is a constant dividend, right? Let's make an assumption in this model, right? The company will pay the same amount of dividend forever, right? On a yearly period forever, okay? So for example, preferred stock, okay? So preferred stock, sometimes they will reward, like let's say the same amount of dividend, right? Let's say they would go 3%. So every year they're gonna give you 3% as a dividend, right? So therefore that dividend amount is constant, okay? Okay, so if this is the model, we can actually compute the price using perpetuity formula, right? If you can recall, what is perpetuity, right? Perpetuity means that you have equal payment, right? Equal cash flows on the regular basis, right? On the regular time intervals. And that time interval goes to infinity, right? So that's the definition. That sequence of future cash flows with equal payments would be considered as a perpetuity formula. And we learned that the price for that equals the equal payment divided by the discount rate R, right? So we learned this from the previous chapter. Okay, let's see. The second one would be a constant dividend growth. So instead of assuming that dividend is constant, what about dividend grow at a constant rate? Okay, so the dividend will be increased by a constant percent every period. Okay. The third one model would be a supernormal growth. So in this model, the dividend growth in the beginning initially is not consistent, but it settles down to a constant growth eventually. Okay, so in the early periods, this dividend are not growing at a constant rate, but after a time point, they settled, right? They settled, and there's a constant growth eventually, right? So this could be, when the company developed to a stable stage, and then they start issuing a dividend as a constant growth rate. Okay, so if we assume dividend does not change, that will be equivalent to say that the growth rate is 0, right? If dividend is constant, that's just equivalent to the saying of the growth rate is 0, okay? So in this case, as I mentioned, the price equals the dividend divided by discount rate. So in this case, let's suppose that stock is expected to pay $0.50 dividend every quarter, and the required quarterly return rate is 10%. What is that price? The price equals the dividend 0.05. Okay, so that's the quarterly dividend divided by the quarterly return rate, which is 10%. So we got $5, right? The price should be $5. Okay, sorry for that, because this 10%, I was speaking too fast. This 10%, okay, I just want to make sure this is a good way to remind ourselves. This 10% is actually APR, annual percentage rate, okay? So when we use this formula, P equals DOR, remember, this D is quarterly, right? This D is quarterly. The dividend is quarterly, every quarter. So therefore, you have to have a matching quarterly discount rate, okay? So quarterly dividend is 0.5, $0.50, and the quarterly discount rate has to be based on the APR, so 10%, and there are annual percentage rate divided by 4 quarters a year. So in this case, I get $20. Okay, so the quarterly rate, in this case, the annual percentage rate is 10%, So the quarterly rate equals APR divided by 4. Okay. And now for the model of the constant dividend growth. Okay, so in this case, dividend expected to grow at a constant percent. Okay, so when you write down the equation, so the present value P0 equals the first year's dividend divided by 1 plus R, second year dividend plus divided by 1 plus R to the power of 2, and the third year's dividend divided by 1 plus R to the power of 3. And you just keep going, right? So the dividends are growing at a constant percent, right? So there is a relationship between D1, D2, and D3, right? So what is that relationship? It's a constant growth, right? It's a constant growth. So now let's take a look at when we rewrite this equation. So what is D1, right? D1 equals D0, okay? So the D0 times 1 plus G, okay? So the first year's dividend equals the dividend just issued, right? The dividend just issued, and times 1 plus G. This means that G means growth rate, okay? So similar idea, D2, that will be D1 times 1 plus G, and that would equal to D0 times 1 plus G to the power 2, G squared, right? And now D3 would equal D2 times 1 plus G, okay? And that would be D0, 1 plus G to the power of 3, right? So now this equation looks like that. Okay, when you bring this D1 and D2 and D3 back to the first equation. Okay, so now we are going to work on this right equation. We are going to do some algebras. Okay, so what we can do here is let's do some algebra here. So let's say P0. So these terms have a common factor, right? I'm going to take that common factor out. D0, okay, and 1 plus G, okay. And let's see, divided by 1 plus R, okay. So now I use this common factor. So I take out the common factor, which is the first term. So I use a bracket. Okay, so 1 plus, here it becomes 1 plus G divided by 1 plus R. Here will be 1 plus G divided by 1 plus R. Now this is all to the power 2, okay? And then you just keep going, okay? So this one equals a number, okay? This one equals, let's see, this one equals, so the cash flow, which is 1, okay? Let's see. Okay, so Q. This one equals 1 divided by 1 minus 1 plus G divided by 1 plus R. Okay, so that's the second term. Okay, and this one equals 1 plus R divided by R minus G. Okay, so that's this second term. So now your P0 equals D0, 1 plus G divided by 1 plus R times 1 plus R over R minus G. Okay, so now you can see that this two term is canceled, 1 plus R. And so what's left is D0, 1 plus G over R minus G. Okay, so that is how this calculation works. So let me show you this equation. So basically, present value equals D0, okay? That's the dividend just issued, right? Times 1 plus G, okay? Divided by R minus G. So R is the discount rate, G is the growth rate. And the numerator, D0 times 1 plus G, that equals D1, the dividend at the end of the first year. Okay, so what is the dividend price under the model of constant dividend growth? So that will be the dividend issued at the end of the first year divided by discount rate minus growth rate. Okay, let's take a look at this question. This is the one example for the constant dividend growth. Suppose the company just paid the dividend of $0.50. So D0 equals 0.5. Okay, it's expected to increase its dividend by 2%. So G equals 2%. If the market requires a return of 15%, so R equals 15% of asset of this risk, how much should the stock be selling for? So P0 equals D0 times 1 plus G divided by R minus G. So D0, that's 0.5, $0.50, times 1 plus G, so that will be 1 plus 0.02, divided by R, so that will be 0.15 minus 0.02. Okay, so that's how we calculate the price. And this equals to $3.92. Okay. So now let's take a look at another example. Suppose a company is expected to pay a $2 dividend in 1 year. So $2 dividend in 1 year. So the dividend, $2, is paid at the end of first year. So here, the $2 is D1, $2. So note, it's not a D0, right? D0 is the dividend you just paid, right? But D1 is the dividend that will paid in a year. So D1, okay, so that is $2. So growth rate is 5% per year, and the required return is 20%. So the price will equals to D1 divided by R minus G. D1 is $2 divided by R, 20% minus 0.05. So this equals $13.33. Okay. So why is $2 no multiplication of the growth rate? Because in this case, the $2 is D1, it's not D0. Okay, if it's D0, you have to consider the multiplication factor of 1 plus G, right? So you have to read the question very carefully, right? In this case, they tell you the $2 is in 1 year. Okay, so that's D1. In the previous question, in this question, the company just paid a dividend of $0.50. So this is a D0. Okay, now let's take a look at the stock price sensitivity to dividend growth. Okay, let's assume the D1 is $2, the discount rate is 20%. So according to the formula, P0 equals D1 divided by R minus G. So my D1 is $2, my R is 20%, 0.2. Okay, so this is my function. So I'm going to plot this function, right? Okay, so my horizontal axis is G, growth rate. My vertical direction is my price, okay? And so the red curve showing that the relationship between the growth rate and the price. So you can see that when the growth rate is under 10%, okay, the growth rate doesn't change the stock price very much. So this area is kind of flat, right? Okay, so when the growth rate is under 10%, it looks like this area of price doesn't change much. But take a look at this. When the growth rate is getting closer to the discount rate, so when the G goes towards to 20%, the price start rising up sharply, right? The price start rising up sharply. So you can see this is the picture, okay? Now, what about the relationship between price and discount rate? So let's assume the D1 is $2, growth rate is 5%. So now let's take a look. Now, the same equation, we are examining the relationship between R and P0. The growth rate is 5%, D1 is 2. So 2 divided by R minus 5%. So this picture looks like this. Okay, my horizontal axis is R. My vertical axis is the price of the stock. So in this case, you can see that the discount rate, as it goes close to 5%, the price has increased very quickly. Okay, the price has increased very quickly. Okay, now let's take a look at a constant dividend growth model. The company is expected to pay a dividend of $4 next period. So that's D1, okay? The dividend are expected to grow at G%, 6%, G equals 6%, recurring return are 16%. What is the current price? P0 equals D1 divided by R minus G. So simple, $4 divided by 16% minus 6%. So that's 10%. So that price would be $40. Okay, that's the current price. Okay, so here, the key here is when do you need to multiply by 1 plus g to the numerator? Well, if the in the information, okay, the dividend information given is for the next period, right? So right away, that's D1, not D0. Only when you were given dividend information of the D0, that's the time you can you have to multiply by 1 plus g, okay? What is the price expected to be in year 4? Okay, so in year 4, what is the price expected to be? So year 4, that's the P4, right? That's year 4. T4 equals D4 times 1 plus G divided by R minus G. P4 equals D5, right? The price of the end of the first year equals the dividend for the 5th year, okay, divided by R minus G, okay? So in this case, D5 equals D0 times 1 plus R to the power of 4, right? So because between, sorry, D1 equals $4, right? D1 equals $4. So what's D4? So D5 equals D1. There are 4 years difference between the two dividend, 1 plus R to the power of 4. Okay. So we know that D1 is $4 and the R is 6% and to the power of 4, right? So that is my D5. And my R is 16%. So now I'm using this formula. We calculated the P price after 4 years is $50.50. Okay. And now you want to know what is the average return, percentage of return. What is average percentage of return, right? So we know the price, the current price is $40. So if you buy this stock now, you have to pay $40. Okay. So you pay the $40, that's the present value, right? And the 4 years later, that's the future value. So you expected this to be $50, $50.50. And so future value equals present value times 1 plus this return R times to the power of 4, right? So then when you solve this equation, you realize that the rate of return is actually 6%, okay? It's actually 6%. So the price grows at the same rate as dividend. Well, price is determined by dividend, right? Because dividend are the future cash flows. So the price is determined by the future dividend. So when the dividend are growing at a growth rate, the price will grow at the same rate, right? So you can see in this example, the price grow at 6%, which is exactly the same rate as the growth rate of the dividend, okay? Non-constant dividend growth, okay? Non-constant dividend growth. So in this case, that the dividend growth is not constant. So let's assume a company is expected to increase dividend by 20% in year 1, by 15% in 2 years. After that, dividend will increase at a rate of 5% per year indefinitely. Okay? So if the last dividend was 1, the last dividend, that's D0. So if D0 equals 1, the required rate R is 20%. What is the price of the stock? Okay, so you go P0 equals, right? P0 equals, so that'll be D1 divided by 1 plus R plus D2 plus 1 plus R square and plus the future D3 1 plus R to the power 3, right? So that's the equation. So in this case, D1 is actually $1. So D1 is D0 times the growth rate, 1 plus 0.2 divided by 1 plus R, 1 plus 0.2, 20%. Okay. Plus D2. What is D2? Okay. D2 is by 15% in 2 years. Okay. So in 2 years, the dividend, the increased dividend by 20% in 1 year and by 15% in 2 years. So in a 2 year, so that'll be D0, 1 plus 0.2. This is D1. On the base of D1, it's going to increase by 1.015% divided by 1 plus 0.2. Okay. So that's this D0. D3, after that, dividend will increase at a rate of 5% per year indefinitely. Okay. So if you take a look at this timeline, so 0 present, you have 1, 2, 3. Okay. So they're saying that after year 3, this is year 3, from year 3 till infinity, now this is the constant dividend, constant dividend growth rate. Dividend growth rate, right? So that's the 5%. Okay, so the question here is what is the this all this, right? Year 4, 5, blah blah, right? So for this future years, year 4, year 5, they continue. This is a perpetuity, right? With dividend growth. So we learned that formula should be your P3, okay? Because you want to know what are this year 4, year 5 continuing, what are the discounted value to P3, right? To P3. So P3 equals dividend in the 4th year, D4, right? Divided by the R minus G. Okay. So what is a D4? Right? D4 is D3 times 1 plus G. Okay. I minus G. So the D3, okay, what's the D3? D3 is D0 times 1.2, that's the first year's growth, and times 1.15, that's the second year's growth, and the third year is 0.05. That's D3. Okay. Divided by R is the rate of, what is R? R is required rate of return, 0.2 minus G is 0.05. Okay. So then you learned that. Okay. So basically, D1 is $1 times 1.2. Okay. D2 is based on D1. On the base of D1, 1.2 times 1.15. So this one is 1.38. For D3, it's based on D2. That 1.38, you have a growth rate of 5%, so times 1.05. So you have 1.449. Okay. And then that's the first step. The second step would be, well, the P2, okay, the P2, okay, the price at the end of the second year, okay, of all these cash flows from D3, D4, D5, these cash flows have this growth, constant growth of 5%. So P2 equals D3 divided by R minus G. So D3, that's 1.449 divided by R is 20% minus the G is 5%. So you know that the price, okay, so the D3, D4, D5, this is continue. These ones are the model we just introduced. So this is the model of dividend at a constant growth rate. And we know that the G is 5%. Okay. So this value will be discounted to a present value at end of second year, P2. Okay. So now you have equivalent of this timeline. You have equivalent of D1, D2 plus P2. Like this, D2 plus T2. This is D1. Okay, so now you just need to discount D1 by 1 year and discount D2 plus P2 by 2 years. Okay. So let's take a look. So now the first D1, 1.2 divided by 1 plus 0.2. And D2, which is 1.38, and the P2 is 9.66. So these two together is discounted for 2 years, right? So 1.2 to the power of 2. So you add them up, the present value is $8.67. Okay. How to use constant dividend growth model to find R? Okay. So let's start with this model. P0, present value equals D0 times 1 plus G divided by R minus G, or D1 minus R minus G. So if you solve it, so you're gonna switch the position, right? So P0 equals D1 divided by RG. So now you switch the position. RG, which was at the denominator, move to the other side, and D1, you're going to move this P0 present value to the denominator. Okay. Okay, so now you move the G to the other side. So R equals D1 divided by P0 plus G. Okay, so that's how you know your expected return in that model. Okay. So R equals D1 divided by P0 present value plus G. Okay. So in this example, suppose a firm's stock is selling for this. So this is my present value. Okay, that's my $10.50. They just paid $1 dividend. Just paid, right? Just paid means D0 is $1. And the dividend I expect to grow at 5% rate. So G equals 5%. What is the required return R? Okay, we know R equals D1 divided by P0 plus G. All D1 equals D0 times 1 plus G divided by P0 plus G. So D0 is 1 times 1 plus 0.05 divided by my P0 is my present value, 10.50 plus 0.05. Okay, so this equals 0.1, 0.10, 0.1 plus 0.05. Your return is 0.15. Okay, 15%. Okay. So what is the dividend yield? Okay, so how much dividend you received? So you received, the dividend you received is 1.05, right? Because it just paid $1, the growth rate is 5%. So in 1 year, you are going to receive $1.05, the dividend. And how much did you pay? You paid $10.50. So this representing a 10% of rate, right? So this is your dividend yield in the first year, 10%. What about the capital gain yield, right? So your total return, R, is 15%, and your dividend yield is 10%. So the difference, 5%, is the capital gain yield. So you can see that the capital gain yield is the price growth. The price growth is actually the same as the dividend growth because price is determined by the dividend. So the dividend growth determines the price growth, and that determines the capital gain yield, right? Okay, so I hope it's clear. You can connect it, all the concepts together. Okay, so as a summary, we have learned about how to determine the price of stock. We use P0 representing the stock price, okay, the present value. So it's all the expected dividend. So it's discounted, right? Discounted future dividend. D1 divided by 1 plus R to the power 1. D2 divided by 1 plus R to the power of 2, right? So this is the generic formula. And now if you think about a supernormal growth, which means in the beginning, initially, the dividends growth rate is not constant. But once it's reached, let's say, a time, okay, once it's reached a time, then the dividend after T, right, after T time, the dividend is at a constant growth, right? So the first terms will be using the generic terms. And after the dividend reach a constant growth rate, you can use the perpetual formula to figure out what's the present value of the future dividend cash flow at this point. At this time point, PT, right? The PT, the price at the end of the time t, will be determined by dt times 1 plus g, okay, and divided by r minus g. Okay, and then you have to discount this pt to a p0 by 1 plus r to the power of t. Zero growth, that means g equals 0, right? So if you think about g equals 0, right? So if g equals 0, okay, so pt p0 equals d0 times 1 plus g divided by r minus g, right? So if g equals 0, you have d0 divided by r, right? Because this is 0, this is 0. Okay. Constant growth case, p0 equals d1 minus r minus g, and d1 equals d0 times 1 plus g. Okay, so you should be very comfortable with this formula. And you can work to solve r equals d1 divided by p0 plus g. Okay. Okay, so what are the features of common stock? So common stock representing shareholders' rights. Okay. So basically, the shareholders, common stock shareholders, they would be able to share proportionally in declared dividend. They share proportionally in the remaining assets during the liquidation. Okay. They also have preemptive rights. So they have the priority to purchase the newly issued stocks in order to maintain their proportional ownerships if they want to do that. Okay. They could have different class of stocks, class A, B, class C. They have different types. You can define different types of voting rights, right? And voting rights is actually representing the control of the firms. Sometimes you also have a coattail provision. So what is coattail provision? That's a statutory provision that enables the holders of non-voting or restricted voting shares to convert their holdings to superior voting shares in the event of takeover offer, right? So if these owners, before a takeover offer, they don't have any voting rights. However, this coattail provision may enable them to convert their shares to the voting shares. Dividend characteristics. First of all, dividends are not liabilities of the firm. Okay. So when dividend became a liability, it's when the board declared a dividend. So as soon as the board make the dividend declaration, that became a liability. The company has to pay the dividend. But without this declaration, the company doesn't have to pay dividend. Okay. Dividend payment, right? You pay the shareholders. These are not considered as a business expenses. So if you pay salary to employees, to the owners, right? The owners can also be an employee. So owners, if they earn salaries, this salary expenses is business expenses, it will reduce the taxable income. Okay. So salary expenses are tax deductible. However, dividend payment it's a cash transfer from the business to the owner. Okay. So it does not go through the income statement. So it's not a business expenses. Therefore, it's not deductible from tax perspective. The dividend received by the individual shareholders are partially sheltered by the dividend tax credit. So what happened is the dividend you received are actually the after corporate tax earnings, right? So the company will first have earnings, and the company will have to pay a corporate tax. So whatever the money left after paying the corporate tax will be in the return earnings and will be further distributed as dividend to the shareholders. So basically, the dividend is actually the earnings after the corporate tax. So this dividend has been actually taxed at a certain percentage or rate at the corporate level, right? So to take that into consideration, to not penalize the shareholders for earning the dividend through corporation, right? The Canadian tax systems is trying to achieve a concept called integration. Okay, the integration means they're hoping that at the end of the day, regardless how you earn the same amount of money, the total amount of tax you are paying are almost the same, right? You can earn this money under your name or through a corporation, right? The total amount of tax you pay are the same. So if you earn this profit through a corporation, you pay a corporate tax, and then you get a dividend. You have to pay the tax on the dividend. So the CRA doesn't want to do a double taxation on you, right? So therefore, the CRA will recognize this dividend tax credit to help you to reduce the tax liability. They are hoping by using dividend tax credit, they can make it irrelevant whether you earn income through corporation or by yourself. Dividends received by corporate shareholders are not taxed. So if you have two corporations, okay, one corporation is the owner of another corporation, okay? So when the corporation issues a dividend to the owner corporation, that dividend is not taxed, okay? So the dividend just can flow through the corporation. Okay. Most preferred shares have a stated dividend that must be paid before the common dividend can be paid. So the preferred shares took the priorities when they take the shares of the dividend. You have to first pay preferred shareholders. The preferred dividend can be deferred indefinitely, okay? So most preferred dividends are cumulative, okay? You don't have to pay them, but it's possible if the preferred dividends are cumulative, then they will keep building up until at the end of the day, the company is dissolved. You will have to use the equity to pay the preferred share dividend first before you can issue any dividend to the common shareholders. Preferred stocks generally do not carry voting rights, okay? So the common stocks shareholders have the voting rights. Stock market reporting. Stock market quotations are published in the newspapers and are also available online, usually with a 15 minutes delay during the trading hours, right? Because the trading happens all the time. That information will be updated in the 15 minutes interval. In Canada, Toronto Stock Exchange Market is where the large capital stock trades happening. Quotes and corporation information on stocks that trade at TSX can be found at the exchange website. So if you go to Toronto Stock Exchange, the website, you'll be able to see the listed stocks and the information about those public companies. So just to summarize, you should know how to calculate the stock price. So the stock price calculation is based on the present value of all future expected dividend. Okay, and there are three approaches to valuing the stock price, depending on the growth rate of the dividend. So the stock dividend, the dividend growth rate can be 0, right? It can be at a constant rate, or it can be supernormal. So that means in the beginning, there is no constant growth rate for dividend. After a certain point in time, there is a constant growth rate. So that's the 3 approaches. And we have seen different examples, right? And then we learn about the rights of the common shares and the preferred shareholders. That's it for this chapter.